Hi, I'm George Lucas. Welcome to the Wealth Know-How Market and Economic Commentary. Two events are set to grab the market's attention this week: the outcome of the US Federal Reserve policy meeting and the referendum on Scottish independence. Both are important for currency markets, which is where most of the action has been taking place recently. The US dollar continues to rally, boosted by the relative strength of the US economy. We believe this theme has a lot further to run. It is driven by a widening divergence between the US, Japan and Eurozone with regards to the outlook for monetary policy. Further support for the US dollar came in the form of a technical note issued by economists at the San Francisco Fed. They pointed out that market expectations for the path of US interest rates is lower than that anticipated by the Fed. This also caused a sell-off in US long bonds, with 10-year Treasury yields rallying quickly up to around 2.6%, from below 2.4% in a matter of weeks. These events demonstrate the sensitivity of markets to what the Fed has to say. After the meeting of the Fed this week, markets will be focused on the nuances in the language that indicate any potential amendment to the pledge to keep rates on hold for a considerable time. Looking at recent US data, including stronger retail sales, lending figures, as well as lower petrol prices and good jobs growth, we expect the market will need to get used to the idea of a sooner than expected rate rise, most likely in the second quarter of next year. The British pound has been weakening against the US dollar, driven by the shifts in yield differentials and the fall in the euro. If the Scots vote yes to their referendum for independence this week, there is likely to be further fallout for the pound. Long term, there will also be other implications across Europe, as a yes vote would support other regions looking for independence, such as Catalonia. Numbers released by China over the weekend were disappointing and likely to lead to more targeted stimulus. The poor data included lower fixed asset investment driven by a cooling property market, reduced industrial production driven by a slowdown in infrastructure spending, lower than expected retail sales, despite recent indicators suggesting the labour market remains strong, and a slowdown on year-on-year credit growth. Whilst these credit indicators are a negative for China in the near term, it's a long-term good sign that there is a focus on weaning China off its dependence on credit to a more sustainable growth path. A final word on Australia, where the economy is still adjusting to the sharp slowdown in mining investment, but is doing better than expected. We expect the RBA to maintain its view and keep the target cash rate at its current low levels of 2.5%. With regards to the currency, the Australian dollar is currently the only G10 currency that is up against the US dollar year to date. On behalf of Wealth Know-How, thanks for watching. See you in 2 weeks.